Imagine losing a trade, not because you picked the wrong company, but because your signal arrived 19 milliseconds too late. That tiny slice of time, roughly the blink of an eye, can cost firms millions, reshape markets, and quietly steer fortunes on Wall Street. Today we pull back the curtain on the race for speed. How milliseconds became money, who built the invisible wires and towers that decide trades, and why regulators are suddenly asking hard questions. And we'll explain high-frequency trading, the infrastructure behind the latency arms race, from specialized fiber to microwave towers, and the surprising real-world consequences when speed becomes an advantage. We'll also look at the latest developments, legal fights, and what it could mean for fairness on the markets. 19 milliseconds. It sounds trivial, but in algorithmic trading, a millisecond is an eternity. High-frequency trading firms use algorithms to detect price differences, send orders, and cancel them, all in fractions of a second. Being even a few milliseconds faster than a competitor can allow a firm to capture the same scarce liquidity and pocket tiny profits at enormous scale. Multiply those micro profits across millions of trades, and the dollars grow fast. Think of it like racing for the last seat on a flight. If two travelers click buy at almost the same time, the one whose request arrives first gets the seat. In trading, that seat can be worth a fraction of a cent, but repeated thousands of times per day, it adds up. To win those milliseconds, firms and infrastructure companies rewired a route across America. In 2010, a startup called Spread Networks built a purpose-built fiber link between New York and Chicago, promising one of the fastest round-trip times on the route, about 13.33 milliseconds. Shaving precious time for market data and orders. But fiber wasn't the end of the story. Engineers looked for even shorter paths, straight line of sight transmission through the air. Microwave networks, a relay of towers stretching across states, started pushing one-way times even lower, producing additional millisecond gains. Researchers later documented a measurable decrease in communication time between Chicago and New York after both the latency-optimized fiber and the line-of-sight microwave networks were deployed, and estimated that the total infrastructure and 5-year operations improvements exceeded $500 million. Why does microwave sometimes win? Signals traveling through air follow a straighter route and aren't slowed as much by glass in optical fiber. Radio waves can hop tower to tower along near-straight paths, trimming both distance and travel time. But microwaves come with trade-offs: lower bandwidth, more maintenance, and vulnerability to weather and interference. Still, when every millisecond matters, firms accept the trade. Because of latency arbitrage, when prices update in one place slightly before another, traders with faster access can buy or sell to profit from those temporary differences. Academic work has framed this competition as an arms race, a costly buildup of speed that benefits the fastest players, often at the expense of ordinary investors and market stability. Recent economic research has quantified the race and its consequences, showing how incentives push firms toward expensive speed investments. Put simply, firms invest millions to shave microseconds because the trading strategies they run can return multiples on that investment. Exchanges and infrastructure providers answer the demand by offering faster access or premium services. And that in turn fuels more spending on speed. Let's break down the main tools of speed traders. Without the jargon, co-location. Firms place their servers physically inside or next to exchange data centers so their orders reach the matching engine. This is standard practice for speed-sensitive traders. Optimized fiber. Companies build straighter, shorter fiber routes and reduce slack to cut travel time. Spread Networks' straight shot across the states is a classic example. Microwave and radio. A chain of microwave towers transmits data nearly line of sight across long distances. When the path is clear, microwave can beat even highly optimized fiber for latency. Custom hardware and algorithmic optimization. Traders use specialized network cards, lean operating systems, and custom code to shave microseconds inside their own systems. Think of it as shipping a message. Co-location is putting your warehouse next to the delivery hub. Optimized fiber is building a straight highway. Microwave is carving a short tunnel, and custom hardware is hiring the fastest couriers. Who pays for all of this? Often, trading firms front the bill. They lease fiber, buy microwave capacity, and co-locate in expensive data centers. Exchanges also generate revenue, by selling faster services or premium data feeds to clients. The net effect: a market where those who pay more for infrastructure can buy time, an advantage that can become self-reinforcing. Researchers warn that this arms race creates social costs as private spending yields private gains but may not improve overall market welfare. Regulators and economists debate whether the net effect is positive, improving price efficiency, or negative, allowing rent extraction by speed-privileged players. Speed has attracted not just engineers and investors, but regulators and litigants. In the last year, exchanges and the industry faced scrutiny over secretively offered extra-fast connections. One major exchange paused a secret high-speed fiber offering after complaints and regulatory pressure, a sign that selective speed access is politically and legally contentious. Meanwhile, legal filings in recent months have exposed how private networks and experimental transmission modes are being used in trading, with rival firms accusing each other of using unconventional or improperly licensed channels to gain timing advantages. Those cases suggest the arms race can spill into courtrooms and that the technological leaps may outpace the rules designed to keep markets fair. These disputes are not just academic. They involve costly infrastructure, large firms, and reputations on the line. When someone alleges a hidden cable or an improperly used radio license, we're witnessing how deeply competitive and secretive the race for milliseconds has become. Does faster trading make markets better? The answer is mixed. Some argue speed improves price discovery and liquidity. Others show how it enables strategies that exploit very short-lived price differences without providing durable liquidity. The academic literature documents both sides, and policy proposals, from new order types to micro delays, try to realign incentives. If markets reward being the fastest rather than being correct, you risk directing resources toward arms races instead of productive investment. That's why regulators are paying attention. Markets should price capital efficiently, not only reward the best network. Behind every tower and trench is a human story. Entrepreneurs like the founders of spread networks convince investors that an expensive straight fiber route would pay off. Trading firms formed consortiums to build shared microwave routes. Telecom companies monetize demand. It's a modern industrial saga of risk, engineering, and huge capital outlays to buy milliseconds. Some projects even resemble classic infrastructure ventures. Engineers deal with land rights, tower leases, and regulatory licensing, while traders monitor a clock to see whether their investment in a new route actually saved time and money. Looking ahead, expect a mix of technological experiments and regulatory pushback. New transmission tech, trials of novel fiber types, and other transmission modes aim to reduce physical propagation delay. But exchanges are watching closely to avoid secret, unequal access, legal, and competitive fights. As firms try creative network tactics, litigation and regulatory complaints are likely to continue. The stakes are big. Market design changes. Academics and some exchanges argue for structural fixes to reduce the value of raw speed, from batch auctions to intentional micro delays, though each fix has trade-offs. Here's the takeaway. Milliseconds are not trivia. They're strategic assets on modern markets. The investments in fiber, microwave towers, and custom hardware show how much money can be made from being faster. But that same race raises important questions about fairness, market quality, and whether the rules need to change. The infrastructure improvements between key financial hubs, fiber and microwave networks combined, have been estimated to cost hundreds of millions over their build and operations life, money spent purely to win a handful of milliseconds that decide who profits and who loses. If you found this deep dive useful, hit like and subscribe. We'll be unpacking another hidden system story next week. Tell us in the comments, do you think markets should limit the value of speed, or is competition for milliseconds just the natural evolution of trading? Thanks for watching. If you want the sequel, we'll show how exchanges try to level the playing field and which policy proposals might actually work. See you next time.